If you can't feed your team with 2 pizzas, your team is probably too large, says Jeff Bezos of Amazon. Hello everyone, welcome back to the Wizards of Dalal Street, a fresh breeze. I'm Ramesh Damani, your host. The secret of running a small meeting is smallness of people. The secret of picking great stocks is straight up ahead when we chat with the founder of Stalwart Advisors, Jatin, Khemani. Jatin, welcome to Wizards.
Thank you, Rameshji. It's a pleasure to be here.
Jatin, I note you write on your website that you don't analyze stocks. You analyze businesses. What's the difference?
So you analyze stocks when you're trading, and you analyze businesses when you want to invest. And you want to invest in them for long term. So the ticker only tells you what price it is. But what value it is only after you understand what the business does, who runs it, what is the strategy, what it can be 5-10 years out. For that, all that analysis has to fall in place.
I think Buffett put it well. He said, price is what you pay, but value is what you get. Let's move ahead and say, you've studied businesses, okay? You studied the paint industry, you studied the footwear industry, many industries. Are there any characteristics that you find that winning businesses have in common?
I think from an India standpoint today, a framework which has really worked well for us is something I call consolidation wave. So these are industries which are large in size, and you would find few organized players but a lot of unorganized players. Almost 60, 70, 80% of a lot of industries is dominated by unorganized players who get away without paying taxes, and organized counterparts do not have a level playing field. So we look back and look at companies like Asian Paints, Relaxo Footwears, Page Industries. These companies have expanded and grown their top line at 20, 30%, some even 40% like Page Industries for a fairly long period of time. But the industries only grew at 10, 12%. The underlying principle which was shaping up was they were winning market share from their weaker counterparts.
Jatin, one of the techniques that you use to figure out which companies to invest in is called scuttlebutt. What is scuttlebutt and how exactly do you do it?
So scuttlebutt is getting information from the ground before they're reflected in the numbers. Once it's in the numbers, it's for everybody to see, right? We don't have any advantage. But if we are connected to the ground, if we are connected to what's happening to businesses, I think we have some edge. We won't always be right. There could be sampling error, first conclusion bias. But in our experience, we have been, the benefits have far outweighed those small misses here and there.
Another way is called kicking the tires. Give me an example of how you use scuttlebutt in one of your picks.
So Relaxo Footwear back in 2012, if you had looked at P&L, it was a pretty average P&L in terms of margins. But the company was doing a lot on the ground through advertisements, endorsing the best of Bollywood, hiring Accenture as a consultant, increasing distribution. They were
Katrina Kaif as brand ambassador.
Yeah, Katrina Kaif, Salman Khan, Akshay Kumar. So they were trying to do a lot of unconventional things which didn't happen in footwear earlier. And the P&L was being actually was suffering in the near term for the longevity of the business. So if you were basing decisions on P&L, you might not like that business.
Again, don't invest in the stock, invest in the business.
Absolutely.
That played out there, didn't
so
it?
The execution was being seen on the ground fantastically, but the numbers were yet to come.
The layman looks at the market. He often looks at tips, inside information, wanting to make a quick buck. Fairly hazardous way to delve into the stock market, isn't it?
There are two ways to participate in markets. One, trade, follow tips and get poor quickly, or invest in great businesses and get rich slowly. That's the time-tested way, and we see a lot of millionaires and billionaires who have created a lot of wealth like that, but not the former.
That's a great point you make. You said you can get poor quickly or rich slowly. The choice is yours.
Absolutely. And unfortunately, we spend a lot of time buying cell phones, but not even few hours before buying a stock, because there is a tip and this is the stock which will make us rich. So we just spend 5 lakhs, we just invest 5 lakhs in that stock and don't even think what that will do.
There's something about human nature to believe in a tip or to believe in what some superior being tells you, but spending inordinate amount of time researching a washing machine or a cell phone, as you said. But you learned all this fairly young. You read a book called Retire Rich, which changed your life.
Yeah, so I always had decent understanding of businesses because my dad had a manufacturing side. I had been to the factory since childhood, and being a commerce student, I understood how businesses operate, but I did not have a very good perception about markets because my dad tried his hands trading and like most lost money. So, and when your dad tells you that markets is not where an individual investor has an edge, it affects your mindset. But that completely changed in my MBA when...
Who changed that?
S.G. Rajshekharan. So he was a visiting faculty and my mentor in MBA. So he was a very senior IT professional, left his job when he became financially independent and started following his passion of teaching. And stocks contributed to that. Investing in great businesses contributed to that. He invested in businesses like Asian Paints, HDFC Bank, Pidilite, way early, and held on to them, and that made all the difference.
Buying, as you said again, not stocks but great businesses and holding them. Businesses mature over decades sometime.
Yeah, so that was the turning point, and that was the first time I was looking at stock markets very differently. I was not looking at them as tickers but as businesses behind them. And then he made me read Warren Buffett and Peter Lynch, Philip Fisher, and that I believe was the turning point in my life.
You know, when you go to New York, they always say to you that you're taking a bite out of the big apple. You took a big gulp or a big serving of a company called Tasty Bite. Tell me how your education, practical experience, philosophy came together in that stock pick.
So we came across this company because we were studying the packaged food, and we understood that in India it's very difficult to do that. We are still too early for that kind of a product.
I think, if I'm not mistaken, Conagra Foods said that India is not going to ready-to-eat market because lots of fresh food available almost in every mohalla in Bombay.
Yes. So when we came across this company, Tasty Bite Eatables, the only differentiating point was that this was not selling to Indians.
Oh.
So it was actually making Indian food but exporting to US, and not selling to NRIs but selling mostly to Americans, millennials who wanted to try different cuisines.
Creating a new niche almost for themselves.
Absolutely. So we found an owner-operated business creating a new niche out of nowhere, following a blue ocean strategy with a lot of skin in the game, and it was still only 150 crores top line. We saw a huge size of the market opportunity, and that's when we thought it could be a great opportunity.
They were riding a wave, weren't you? Millennials want to try new food, organic food, healthy food. Was that example of great management showing fire in the belly?
Absolutely. So these were guys earlier working for HUL and Pepsi, and they left their job and bought this company from HUL. And from nowhere, 4 crore turnover, they took it to this level. So when I met them, I could see that fire in the belly, that they are not just working for money. They really are passionate about what they are doing, and there was enough skin in the game visible.
You know, you talked about better earnings kicking in through operating leverage. I've often heard that. For my viewers, explain to me how operating leverage works and why it's important when you look at a stock.
I think it's a very important concept as investors, as analysts, we should look at, because when we think about earnings growing, by default, we assume expenses will also grow, but that's not always the case. There are some businesses where bulk of the cost is fixed, and as their sales grow, most of it falls down to their bottom line. A beautiful example of that could be another company in which we have invested called Wonderla Holidays. Again, it is not a recommendation, this is just for illustration purposes.
Understood.
So this...
How does operating leverage kick in to Wonderla? First, what does Wonderla do?
So this company is the largest amusement park operator in our country. They operate 3 parks based out of Kochi, Bangalore, and recently opened one in Hyderabad. So let's talk about the first 2 parks. These 2 parks on an average daily entertain 3,300 guests, but they have a capacity to handle 12,000 guests.
So as they come in, it starts flowing straight to the bottom line.
Absolutely. Your costs do not go up in proportion to your top line, so your bottom line grows disproportionately.
You've often talked about management having fire in their belly. What do you mean by that? Is it just a colorful expression, or is it something that you can actually gauge in management?
So there are 2 parts to it. One, we always, whenever we're liking or starting a business, we try to go behind and spend a lot of time on the management. Is it an owner-operated business, or is it professionally run? We generally find owner-operated businesses have more skin in the game, and especially if it's first-generation entrepreneur, that is something that really excites me, because he started from scratch, growing it, it's his baby. Chances are high that he's passionate about it. It can go wrong also, but there's a fair amount of the probability is high that he's passionate about it. Yeah, incentives are aligned, and there are other ways to look for it. So skin in the game. what kind of promoter holding he has, is he drawing a lot of salaries before sharing the rewards with minority?
Is he doing creeping acquisitions, stock buyback?
Yeah, and are there entities in similar business outside the listed entity? So this is something we really focus a lot on, related party transactions. That tells us about the skin in the game.
You know, when you run Stalwart, people come to you for advice. Is there a lot of pressure for you? Because you're still fairly young, you're nascent in your career. Is that pressure for you?
So far it hasn't been, because we have tried to attract like-minded investors. We have been very vocal about our philosophy. We have put a lot of information on our website.
Pretty transparent, your website says a lot.
We have tried to be very, very vocal about what we are trying to do. We are not selling get-rich-quick dreams. We are saying...
You're saying retire rich, actually.
Yes, retire rich. So it'll take time, it'll be a long-term thing, but the probability will be high that something beautiful could come out of it. We're looking for great businesses, and we want to partner those managements. We're not looking for quick bucks.
That's well said. Jatin, thank you so much for being a part of our show today.
Pleasure being here, sir. Thank you so much.
We'll see you next week on another episode of the Wizards of Dalal Street, a fresh breeze.